Welcome to the daily update, where I'll go over the action in the market for Monday, December 16th, and we'll see how things look for Tuesday, December 17th. Kind of the same story that we've been seeing. The broader market is weaker. We're seeing some internal deterioration in the S&P 500 and across the NYSE, but at the same time, large caps, mega caps, doing quite well, growth doing well, discretionary holding up well. The growth areas of the market ended up being up, where the rest of the sectors, including the defensive areas, they ended up being down in Monday's session. So it's still looking like this could be a setup for things to finally take off and go up. We don't have any confirmation of that, though, based on price, and we have to wait for confirmation. Now, some people try to front run this and get themselves set up. That's a personal choice, but my approach to this is wait for the market to prove itself to you because anything can happen in the meantime. I don't implement buy the dip mentality, which kind of happened in Monday's session. A lot of people do, and a lot of people teach that. I like to buy into strength and I sell into weakness, letting the market actually show me what's happening instead of trying to front run that and come to my own conclusion before it ultimately happens because you can be wrong, but you'll be right just enough to justify that, okay, I'm doing things the right way. You're gambling at that point, and we've got enough risks that we're taking anyway without having to already have the market tell us, okay, this is what's actually going on. Okay, before I get into the video, there's a thing called the SPX Investing Program. It's a program I have. It's free until the end of 2024, so we're coming kind of close to the end of that. If you want to learn more about the program, there's a link that'll take you to the website. There's a link that'll take you to a video. If you have any questions, you can email me. And right now, the one of the biggest benefits is that you get access to these videos right when they're available, where I hold them back on YouTube and Rumble. And there are also additional videos that I post on the website. The daily video, as I say all the time, is the real foundation of the analysis that I do. We just finished the weekend. I did the outside videos. During the week, I focus on the daily video, and that's where I update things that we're seeing that I talk about in the weekly videos. All right, let's go back and talk about what happened. We did have a higher open. Futures were able to claw their way back until we saw prices looking more positive right at the open. And then we hit some resistance at R1, 6,075. Then we were able to get above that. So sometimes when we hit resistance, we turn and come back down. We just slowed down at that point. We got above the 60-80 level, but then we saw some late day selling, which ended up taking prices back down to close slightly below R1. We were up 0.38%, where we had been stronger than that earlier in the day, and we were above average with volume. So we are seeing that picking up. And we are still positive in the short, intermediate, and long term. It's just in the intermediate term, we're seeing this weakness, which has been bleeding through not only the intermediate term, but somewhat into the short term, and even showing a little bit of change with our long term charts. But taken all together, we are positive for the time being. And the market's dealing with inflation and interest rates. We had some new reads on inflation last week, which is pushing interest rates back up, especially the report that came out on Friday, the PPI. The market wasn't quite as happy with that, where CPI came in more as expected. And then the Fed's going to be coming out and probably going to cut rates 25 basis points on Wednesday. The market has like a 96% chance that's what will end up happening. But then it's also what they say in their initial statement, the report that they come out with, and then the press conference that Jerome Powell will be doing after that, and all kinds of crazy geopolitical things that the market is just not really paying attention to. If we see an escalation of things, I may have to add the Baltics to this list. There's some kind of crazy things going on between Russia and Germany up there in the Baltic Sea. So, interesting times, but the market is just humming along nonetheless. Some comments. It was a mixed session with the large caps and growth continuing to outperform. And some of the indexes were up, some of them were down, and I'll go through those. But the large caps and growth, they're really holding things together currently. And higher interest rates, they're continuing to pressure stocks. We didn't really see much of a drop in Monday's session, and that's when it starts to bite into corporate profits. And here we have the Fed probably going to cut rates even more, and interest rates have been going back up. The VIX was up on an up day. That's strange. Usually they go in opposite directions from each other, but we did have the VIX advance even though we closed positive. And I'm really watching the semiconductors right now. They're a real foundation of the tech sector, which is also a real foundation of the overall market. We're at some critical levels with the semiconductors, and it depends on which chart you actually look at. And I have both the charts that I've been following that I'll show you later on. But they were up, so we're seeing an improvement there, and that's helping the large caps and growth to do better. We still have this non-confirmed Hindenburg Omen. We'll have that until Thursday, which actually means Friday because there's a 1 day lag with how that chart is updated. So we'll just have to see if we get another spike. We've only had the one spike that was generated. Now we're waiting to see if we're going to get another one. And be aware, the perma bears. I get a few of the emails, and there's a few of the perma bears that I follow that no matter what evidence you throw at them, doom and gloom are just around the corner, even though they're wrong most of the time. They're treating these Hindenburg omens, or at least they're seeing multiple ones. I only see the one, but I think they use a little different definition than what I work off of. They're just predicting that things are looking pretty bad. So that's actually positive for the market since these folks are wrong so much of the time. And on a short-term basis, we're coming down with the stochastics, but our longer-term chart, it's still extreme positive. In the intermediate term, the Sean trend meter, which you could also take as being positive. Even though we've been chopping sideways, we've been seeing some internal weakness inside the S&P. The Sean trend meter has been holding up fairly well, and we were unchanged with the Nasdaq 100 bullish percent index, and this is where the strength is coming from right now. And as long as that holds up, positive things are still potentially developing under the surface, not only for the Nasdaq 100, but that also would flow through to the S&P 500. Intermediate term, we still have the McClellan oscillator. That's going down, and this is part of the internal weakness that I'm talking about, where when you look at the index, we're hanging in there, and the large caps and growth are doing okay. But most of the stocks in the S&P, we're actually getting an extreme negative reading here with the McClellan oscillator, which could end up being positive because it's looking like there's a potential setup here. We're just not seeing the rest of the stocks really participating. And if we do get into the period of positive seasonality and then start to go up, there's a lot of stocks that really haven't participated in this yet. So just, I'm not saying that's what will happen, but you could make a case for that, and we'll just see if that's the type of thing that ends up unfolding. And then there's the PMO, the price momentum oscillator, which was developed by Carl Swenlin. That's kind of his foundational indicator that he developed. Well, he's also developed a bunch of additional studies to go with that, and we're still getting some extreme readings there, which is kind of lining up with what we're seeing in the McClellan oscillator. And I'll show you charts of all these things. And it does look like the Fed is going to come in and cut rates, even though there's been some back and forth. It's like, this inflation data that came out, that's causing Jerome Powell to be a little bit uneasy, but the market's pretty much anticipating that there's going to be a rate cut. So that's part of the back and forth that's going on there. And the dollar was down, interest rates were up. It depends on what chart you look at. One chart that I look at had the 10-year actually being down slightly. The other chart that I look at had it being up. So one is right when the market closes at 4 p.m. Eastern. The other one kind of carries over after the close. And sometimes the numbers can be a little out of line with each other. We're coming in at 4.41% with the 10-year yield, and that's quite a bit higher than where we were at. And the general trend of interest rates have been back up, and that's not helping at least the rest of the S&P and the broader market right now. They don't like these interest rates being as high as they are. And we're uninverted now with both the 10 to the 3 month and the 10 to the 2 year. They've both gone back to being normal. So I'll probably talk about this for a few more days, but if we stay uninverted with both of these, I'll probably drop this off the list. I've been talking about this for 2.5 years on this particular page. I want to get this gone here. But what we're going to start to do is keep an eye on recessionary type things and look at the charts that suggest we could go into a recession, the other charts that suggest we won't. Follow the data. You're going to hear all kinds of conclusions and people dogmatically come out and say this is going to happen, that's going to happen. I look at the data. And yeah, I know the data is manipulated, but it's what the market uses to make decisions. So that's what we have to use as well. And sometimes people come up with these inside looks at things, and I like to do that with charts, but not when it comes to information because I've heard all these conclusions that people reach, and they put a video on YouTube or they have a newsletter, they have a blog or something, and they think this is the end all answer to everything, and then it ends up turning into nothing. Why? Because the market doesn't pay attention to that. So we pay attention to what the market pays attention to, realizing that, okay, the data could be a little bit more accurate than what it is. Sentiment is positive. We ticked up there. We closed at 57, where after Friday's session, we were at 50, which was right on the fence between positive and negative. And we're still seeing a weakening trend, though. We're positive. The green line's on top, but we've been chopping around over the last number of sessions. The ADX was right on top of the moving average, and now it's starting to drop below the moving average. But we're still above 20, so we're still in a trending environment. And with the update, the bias is positive. I'm still keeping the momentum at mixed until we break out to the upside and turn more positive or actually start to drop to the downside. It's you can make a case for each, and our indicators are giving us a mixed picture right now. So we did get the New York Fed Empire State Manufacturing a lot weaker than expected. It came in up 0.2%. And I know I turned on my pointer. Why isn't it on now? But they expected it to be at 10, and last time it was at 31.2. So that was quite a drop off there. And these don't have much of an impact on the market, the S&P Global Manufacturing PMI. The takeaway from this is that we came in under 50, and that shows contraction. We came in at 48.3. Last time it was at 49.7. So we've been under 50 for a while now. When you look at the services, though, we're coming in at 58.5, and that's above 50. So that's showing expansion, and that's up from the 56.1 that we did see last time. The only chart I'll show here is the Empire State Manufacturing, where it was still positive, but quite a bit less than the reading that we saw last time. All right, then going through some Isabel Net block charts. Says we expect the S&P that will rise to 6,500 by year end 2025. Okay, you can come up with whatever projection you want. Let's say S&P 12,000. Why not? Just pick a number because people love projections. They love forecasts. It's like the weather. People really pay attention to that. Even though you can look out the window and tell what the weather's actually doing, there's this hope that people that know more than what we know actually have a clue to what will happen going into the future when really nobody does when we come up to that. That's why my approach to analysis of the market is just day by day. That's why I put so much emphasis on the daily videos. And then we just readjust as things develop. But they're thinking that at Goldman Sachs that we're going to go up. Now, we get a bit of a downturn, we go through more of a decline. This thing's all going to change, and you're going to see downward projections coming out. All right, then the presidential cycle week in the second half of a post-election year, just something to think about. We've got 6 months, 7 months before we even get to that time period. But right after we have a presidential election, that tends to be a positive time. But then going into the second half of the year, now on a historical basis, this is when we see some weakness. But we've got a little bit of time to get ready for that. And quarterly earnings per share, this is on a seasonally adjusted basis, still looking pretty good here, and Deutsche Bank still has the earnings going up as well. And as I always say, when earnings forecasts and reports are looking really solid, that justifies stock prices actually going up. And equity positioning across the sectors. What's interesting here is we have a lot of money in staples, and that's more defensive. But you can see this diamond here, the green diamond, it's actually coming down. So there's still a lot of money in there, but we've been seeing the positioning actually dropping off. Where the next area would be the mega caps and tech. That's the real growth area, and that's really solid. And we're seeing the green diamond actually above here. And that's kind of the takeaway I got from this area. All right, and the VIX or volatility indexes, we call it the VIX here in the US, but it's comparing the VIX equivalent in Europe and in Japan and just showing that volatility right now is quite low. That's really the takeaway from this. And then years ending in five. Yes, we have to do this very scientifically. They have the highest average returns. So the median and the mean, 20.7. The median here is 26.3, and we're positive 92.3% of the time. It's kind of like, the Super Bowl indicator or which team wins the World Series or, all that stuff. Folks like, some people use the planets and where they're at and the it's crazy. But okay, maybe you want to base your whole long-term portfolio on the fact that we're coming up to 2025. I might want to be a little more scientific than that, but hey, at least history's on its side here. And then I did find a few charts, and this is put out by Chris Shavako, and that's a video that I would highly recommend. He puts out a weekly video and he takes a longer term approach than what I do. I focus on the short and intermediate term and then the long term with SPY positions. And I basically go with the trend where if I use a moving average crossover for my long term portfolio, and then I implement hedging and covered call writing and I set up callers and things like that to protect what I already have. And I teach that in the program, but he's where I'm an educator, and that's why my videos are longer, and I'm not trying to indoctrinate people with some kind of conclusion, which that's why not as many people watch my videos, and I don't have as many subscribers on my YouTube channel because I want to educate people how they can do it for themselves. I'm not trying to come out and say, this is what you got to do, that's what you got to do. And I get a few crazies that come along the way. They're looking for answers. They're looking for a religion or some kind of a guru to actually tell them what to do, where I don't do that. Chris Shavako is a money manager. And so I come from an educational standpoint. He comes from a money management standpoint. And I like his videos. And he puts one out every week, usually over the beginning part of the weekend. And he's got some good insight and he relies heavily on technical analysis. He also uses the same approach I do, where it's like, don't forecast, don't guess what's going to happen down the road. Just go with what we see right now. Well, one of the charts that he posted on his Twitter account is the tech to energy ratio. And it's taken a long time here, but we're finally starting to break out with tech outperforming energy. Now, energy hit was really good in 2022. You can see where tech really underperformed because we were in an inflationary environment and tech got hit, energy was going up. We're finally starting to see this reverse. Now, it has been improving going back to the end of 2022 when we hit that bottom in October. So this has been really improving. But here, he has a couple of lines that he's put on here, and we've finally been able to break above that. So that's encouraging, and that bodes more well for the market staying positive, regardless of what the perma bears say. But you look at the evidence here, and this is a growth area when tech is doing better and showing even more improvement. And then also, this is another kind of funky little sentiment gauge that I found on Twitter. And it's just telling that we're getting a really high reading. Now, the one that we look at, where I talk about sentiments at 57, where it had been at 50, that's the CNN Fear and Greed Index. And that's what I follow because it's updated multiple times throughout the day. And it's also then updated at the end of the day, where a lot of these other ones, they're lagging. And I want to get a better taste of what is actually happening with sentiment. That's why I follow a different one. And this one is just still suggesting that we're looking extreme. And then this is what I've been pointing out. The S&P has been holding up fairly well, and we're not far from that all-time high, but we're seeing market breadth really going down. It's a lot more negative. Now, could this suggest that we're getting to a point where we might be able to bounce up out of that? Yeah, of course that could happen. We haven't seen it confirmed by price yet, but we're just seeing a real switch over where it's just a few stocks right now that are really keeping the market together, at least for the S&P. And then Sentiment Trader, another phenomenal website with some really unique studies. And this was posted there just saying value is nearly the cheapest relative to growth in 40 years, or whatever you want to say here. We're coming down where the ratio is really quite small. And we're seeing growth doing well. And while growth is doing well, that means value is underperforming. And that's causing this ratio to come down. And, value was helping out earlier in the year. We're not really outperforming with anything all that drastic. This big spike up, this was 2022. That's when the market gets more defensive. So you could take this as a positive and that growth is outperforming value. That's good. And I have a number of charts to show you that later on. But you could take this in another way that if we keep starting to fall here, that could be even more positive for the market. But then you could switch that over and say, well, maybe there's some good opportunities in the value sector because they haven't really been participating, even though we've seen some improvement throughout 2024, where the rest of the S&P, the rest of the market has been improving. So there's a couple of different ways to look at this chart. And then this chart is the same as what we just saw, but this is called the arithmetic scale, where people like to fancy it up and say arithmetic. Yes, I'm going to my third grade arithmetic class. No, it's arithmetic, where this is a log scale, and it's just a different way of being able to display charts here. We're pretty much seeing the same result. Okay, let's go talk about our charts here, where we did move up. Not much of a gap, but we were still below R1, but we did have a positive open. Because we've been chopping sideways, these moves look a lot more exaggerated than usual. We really haven't been moving all that much as far as the price action of the S&P. But we did have a positive open, and we stalled out right around this R1 level. And instead of breaking down below it, which is quite often what happens after the open gets more dealt with, we actually broke higher and we got above the 60-80 level. And but then we just stalled out here. Again, we're close to that all-time high, but not quite there yet. And then we saw some late day selling, which took us back down to R1. And here's the intraday chart. Not seeing too much in the initial overnight session. It's pretty quiet, a little bit of a downtick there. But going back to the beginning of Monday, where we were a little bit negative when we first opened Sunday afternoon and evening, and then we just saw the futures clawing their way back and actually turning positive, and then that took us over into the cash session. This is still positive. We're seeing the blue line going up, which is growth on an intraday chart. We're seeing the red line going down, which is value. And that's why we're seeing the value really underperforming right now. Charts like this is actually more positive for the market since growth has been holding up quite well. This is also looking good. We look at S&P growth to value. If you go back to the latter part of November, we've been seeing this ratio going up on this intraday chart, and it's continuing to show strength. And that could be under the surface strength that just hasn't come through yet as far as price. On an end of day basis, growth was up over 1%, where it was down over 0.5% with value. And it was up with the mid caps and up more with the small caps. So we're seeing some smart money coming in and actually buying some growth areas, but it's not having that big of an impact on the overall indexes. And looking at this, the small cap growth to value ratio, really looking good and in an uptrend right now. Mid cap growth to value, looking really good and in an uptrend, even though you see the index just kind of blah, 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 just trailing off here. And the S&P growth to value starting to break out, looking stronger, even though the S&P has pretty much been going nowhere for the last week or so. Looking really good here, breaking out above this previous high that we set last summer when things were looking really strong. When we look at the growth versus value ETF, discretionary to staples, not really breaking out, but still holding up and doing quite well. And as I've been pointing out, this is the discretionary sector has been the best performing sector since we saw that big down day last August when the VIX went to like 65 and the end of the world was coming and they were calling for emergency rate cuts from the Fed. That lasted what, a day and a half, 2 days maybe. And The world forgot about that and we went on to other things. Large cap growth setting another new all-time high and up really solid here. Our trend, we're starting to drop below the moving average, and that suggests a weakening trend, but we're still trending since we're above 20, and we're still positive since the green line is above the red line. And we're dropping a little bit further below. You could have made a case for this after Friday that in the short term we're dropping a little more below the moving average than what I led to believe in that video. And it's even dropping off a little bit more now. So is this building up to something kind of big? We don't know yet. And we don't know really when that could potentially happen. And we're still dealing with above average as far as volume here. Sentiment, this is a weekly gauge, and that's why I don't really rely on this one because we only get it once a week. It's a composite of a bunch of different things taken together. This is still suggesting that we're extreme positive, coming in at 84.45. Another sentiment gauge that we get once a week is what are insiders doing? And this is legal insiders like corporate officers and CEOs and people that know what's going on. Are they buying or are they selling? And we've seen this really dropping down a little bit, getting more to a neutral reading. And when I show that chart, I also show this next chart. This is the insider buying ETF, which really is in an uptrend, but there hasn't been really exploding to the upside. It spent most of 2024 pretty much going sideways. And then I usually show this in the weekly video because it updates on Saturday from IsabelNet. I didn't update until Monday. This sentiment indicator is also coming down from an extreme reading. But when we're above this dashed line, that means the market could be considered a little too positive. The VIX went up on an up day, and that's kind of strange. We're seeing some hedging going on ahead of things that are going to be coming out. We have retail sales coming out on Tuesday. And then we got the Fed coming out with their stuff. And so some folks may be hedging using the S&P 500. And when that happens, the VIX goes up both on a closing basis and with the bar chart. But we're not seeing much of a change here with the VIX of the VIX. Usually they move together with each other. This one didn't move all that much. But the momentum of the VIX is switching back to up. And I use the MACD to measure that. And we've been going up enough here to see the MACD starting to turn up. And that could be negative for stocks. Seasonality is where we're going down, though. That's typically what happens this time of year. And that's positive for stocks. We're still getting a very high reading with the skew index, which is a variation of the VIX. The VIX uses at the money options to calculate itself, where the skew index uses out of the money options, above and below current price. And we're still up in this red area that the market is expecting some kind of a big move. And we declined a little bit with this fear gauge. We were up just a tick with this other fear gauge. So we're seeing some bit of a contradiction there. This is what I've been pointing out with the risk on versus risk off. Folks are getting more into the risk on, which is positive for the market. They want to get into the stocks, the Nvidias, the Apples, the Netflix, Google, and all that. And so we're seeing this ratio going up after it had spent a long time pretty much chopping sideways. And we came down with the equity put call ratio on the daily chart. And so, and I don't know if I updated this later, we're starting to roll over with the 5-day and we're looking pretty extreme here. This is turning back to positive now when it goes down. And we're also starting to come down with the 10-day average. And that's also more positive. And still getting a pretty high reading here above the band when we look at volatility risk premium. This is another sentiment gauge that we look at, that there's still some fear out there that's being anticipated in the short-term future, usually looking out 30 days. We're still declining here with the advanced decline line based on price and volume. And one of the charts that I showed earlier that I got off of Twitter, it's showing this weakness. But we're still positive longer term since we're above these advancing moving averages. Also seeing a bit of an expansion of the new highs, but we're also seeing an expansion of the new lows. And so that's still causing our 5-day and 10-day moving averages to go down. And this is one of the internal measures that's not looking really strong currently, but it's not necessarily falling apart either. And this is negative. This is a smart money indicator, accumulation distribution. We're still below the moving average, even though we turned up a little bit here. And we're below zero and declining with our short-term and intermediate-term advanced decline ratio. So we're below zero with the 19-day advanced decline ratio based on price and volume. So this is some of the weakness that we're seeing in the market currently. We're improving a little bit here with the Chaikin money flow, trying to flatten out after we had been declining. We ticked up a little bit with the histogram on Friday and a little bit more on Monday. So this could be showing signs of improvement. But then we're still negative with the Chaikin oscillator. It's ticking up barely, but still negative. It hasn't crossed back above its short-term moving average. And we're positive here with the vortex, but not really showing an awful lot of strength. The green line is pretty much flat and it's still on top, but the red line's starting to come up as well. This is also picking up a lack of strength currently. Coming down with the advanced decline line for the S&P based on price and volume, even though we had an up day. And we're seeing a bit more of a disconnect here. Now, this is not quite a true comparison. The bar chart is the S&P 500. The NYSE is the advanced decline line, and it's going down where the S&P has actually been holding up. And that could be taken as a negative divergence. Also declining with the cumulative advanced decline line on the NYSE, dropping further below the moving average with our regular NYSE advanced decline line, also dropping a little bit further below with our other NYSE advanced decline line. Breaking it out based on common stock, we're still declining based on price and volume. Still below the moving averages here with the NYSE common stock, the S&P, the mid caps. We ticked up a little bit where all the other indexes still continue to decline. I guess the mid caps were slightly flat, but we ticked up a little bit here with the small caps. And this is what everybody's anticipating. We're coming into the latter part of December, after the middle of December. This is when small caps are just magically supposed to automatically do well. Well, we'll see how that plays out. And it very well could happen. This is a little bit longer term indicator looking internally at the S&P. This is the 10-day average of the highs and lows in the S&P, and we're continuing to drop here. Where most of 2024, we've been above this green line, showing good short to somewhat long-term momentum for the S&P, and this is dropping at this time. And then we look at a broad market measure of a 5-period moving average of the highs lows. We're starting to drop below zero here. This is also showing the weakness that we're seeing throughout the broader market. And we're declining with those stocks above their 20-period moving averages. And what is this? It's really hard for me to see that. I have to pick up some glasses here. We're at 28.8. I don't know how you get 0.8% of a stock, but when you do with percentages, you have decimals too. But this is declining and below 50, and this is part of the weakness that we're seeing. The S&P has been holding up okay, and this could end up being positive, but we're not seeing the rest of the stocks really participating currently. And we're also below 50 with when we look at those stocks above their 50-day moving average in the S&P, declining. We only have 55% above their 100-day moving average, and we're down to 63.6% above their 200-day moving average. Now, could this be? This is just speculation on my part. We don't know if it's going to play out this way. Could it be that the market's hitting some kind of an oversold condition without really doing it? You can make a case for that we're seeing this internal weakness. We're getting down to extreme negative readings in some cases. And then we get into this positive seasonality. We start to go up with the S&P with a market that's not immediately going to become overbought at that point. I'm not just something to think about. All right, short term, kind of chopping along sideways here with the daily chart, and we did go back to above average with volume, but we're still declining with the 20, 50, and 200-day moving averages. We're not quite extreme anymore with the Stochk RSI. When we had the downward moves that we saw, we started to get extreme negative with this indicator. It's actually improving a bit now. And we never did get all that negative with the Williams percent R. It's still above the midpoint and starting to go back up. Also above the midpoint with the CCI 14 and the CCI 20. And these are our usual charts that when we're significantly trending in one direction or the other, these become overbought or oversold really easily. And we're not seeing that, and we haven't seen that for the last number of days. And turning back up, but not extreme in the short-term stochastic, still declining in the intermediate short term. And we're still extreme here with the long short-term stochastic. And the reason I say it that way is this is just a further subdivision of the short-term time frame. And still looking positive here with the force index, but below the midpoint. And we're looking a little better with the condition of our short-term trend as measured by 20 periods. The lines are still going sideways here. If we can get above that, that'll turn the lines up. If we drop below it, that's going to turn the lines down, and they're flatlining currently. We're still above the 20 period simple and exponential moving averages. We have not seriously tested that. If we keep chopping sideways, eventually the moving averages are going to bump into price. So maybe that'll end up being some kind of a weird test. And still looking okay here with our standard deviations chart, just barely into the +2 channel. It's when we get concerned is when we get up into the +3 channel, or if we drop below the midpoint. And neither of those are happening right now. And ticking up a little bit after coming down and almost turning negative with the balance of power. This is a condition of the intermediate term trend based on 50 periods. Still going up with the lines. Saw a bit of an update coming back up to the blue line. It'll be more positive if we could go up. If we start to drop, it'll turn these lines down, just like on the previous chart. And this redrew a little bit. We're turning more neutral with the go, no go since it's switching over to a lighter shade of blue. Still looking positive here. We're above the midpoint with the highest high, lowest low value chart. Still seeing some weakness with the TTM squeeze. We've been going sideways with the S&P. This is turning darker blue and declining. So that's more negative. Still positive with the ease of movement, barely above zero. The Erin indicator, no change there, also above zero. This is still positive. And this is the S&P McClellan oscillator, where we're getting to an extreme reading and we're continuing to fall here. This is part of what I'm saying. Could the market actually hit an oversold condition without really showing it on price? Sometimes during this time of year, we can have a sideways correction. Believe it or not, it has happened before. We'll see if that's how it plays out this time. But right now, this is negative. So when that's negative, we're declining with the summation index based on price and volume, and we're starting to drop below zero. This is the line in the sand between positive and negative. We're looking a little more negative here based on volume. We look at the NYSE McClellan oscillator, not extreme, but still continuing to decline. And when we're below zero here, we're turning down with the summation index for the NYSE based on price and volume, actually showing a little bit more intensity. We haven't quite gone below this previous low based on price where we're already dropping below it based on volume. And that's a little more negative. So, I mean, there are things to be concerned about here. And we're still declining with the Swenlin trading oscillator based on price and volume, and we're below zero. So this is negative. Momentum is starting to take a hit. We're dropping below the moving average with the PMO. Now, one thing that was encouraging, we saw the cross below the moving average when we break it out based on price and volume. That actually happened before we started to show more weakness with the PMO itself. So that gave us a bit of a heads up there. This is where we're looking extreme. With the PMOs that are rising, we're getting to an extreme reading. And you might want to look at other times. Sometimes you see we hit a bottom here, and then we still had a ways to go before we saw a nice little up move. We saw an extreme reading here where we spent some time chopping around before we went higher. Other times, this is right after actually, this is the decline going into the election here. And so this could suggest, okay, maybe something is getting set up that could end up being positive. But we don't know that for sure, and we don't know when that's actually going to happen. And we're still declining with the buy signals as well as the PMOs above zero. And we're dropping below the moving average with the slope oscillator. It's actually trailing off as the S&P has been going sideways. The MACD is already negative on a short to somewhat intermediate term momentum basis. So we're rolling over with the slope and the TSI. Now our short-term oscillators are confirming each other. Also showing some weakness with our intermediate term oscillators and coming back down to the moving averages with our long-term oscillators. And still below the moving average with the Copic curve. This is another momentum oscillator. And this is what I was talking about the Sean trend meter. Just kind of moseying along sideways right now. Not really showing any strength, but not showing any weakness either. The money flow is declining, but still above 50, where the ultimate oscillator ticked up, but it's still below 50. So that's actually turned negative. And we ticked up since we had an up day, and we're above the moving average when we look at on balance volume. Still looking good with the RSI and the intermediate term based on 14, as well as the short term based on 9. When we're above 50, that's showing good longer term momentum when we look at the longer term version of those charts. And we've gone from neutral to positive with the Elder's Impulse system. We're still negative, though, with the parabolic SAR. We're going to have to break above these previous highs, possibly for that to change. Moving averages, though, still looking really good there, but we're declining with the bullish percent index. And as I talked about in the weekend video, I like the bullish percent index because they're a completely different kind of indicator. It's not a momentum oscillator, it's not moving average based. This is measuring the point and figure buy or sell signals in the S&P. And when this is going down, that means the number of sell signals are increasing. So the fact that this is still going down, yeah, that's a concern. We want to see this turn and go back up to turn more positive. And we're also declining with the NYSE bullish percent index, but we're flat at the 70 level. This is actually positive because we're holding up at a high reading now with the NASDAQ 100 bullish percent index. And we're coming up to the top end of this trend line here, which maybe we're going to be able to get a little bit above that at some point. But this could be acting as overhead resistance longer term. And then the Heiken Ashi, where you can see this. This is a pretty good measure of trend, and we're just chopping along sideways right now with very small candles. We're still positive with the Kagi chart. We're positive with the Renko chart, but we're still negative with the three-line break charts. And then long term, we are seeing a bit of a decline with our 150 and 200-day moving averages. I pointed that out in Monday's video. We're still seeing a continuation of that. Then this is interesting. This is a Horchak, and I noticed this is after Friday. There's a 1 day lag here. We actually had a drop where we had been a full on buy signal at 10. Now we're dropping back down to 8. So it's picking up some of this weakness that we're seeing in the market too. And this doesn't give very many signals. Now, it's not turning negative, but it is showing some weakness right now. If we do turn and start to go back up, we'll want this to go back up to 10 at some point. The sooner the better. It'll look more positive. And no changes here. We're still negative with the mid caps and small caps, mid caps and small caps in the short term. All right, no changes here. Negative with bonds based on price in the intermediate and short term, still looking more positive with commodities. Actually, I went to go look at the chart here. They've got like a big blob there. There's no arrow at stockcharts.com the last time I checked. And this is encouraging too. The growth areas were the areas that were up: discretionary, tech, and communication. Now, industrials were up a little bit, but these are the three areas. These are the growth areas. These are the mega caps. These are the large caps. We want these areas to do well, and that's what really carried the market in Monday's session. And we're seeing the Christmas theme going on here. Utilities crossed back above 70 with their BPI. And then tech had a BPI cross above 70, but then utilities crossed back below 70. So it's like neener, a little bit of a tease here and then freak out later on. And we had energy with the BPI crossing below 50 as that's been under some pressure. NASDAQ setting an all-time high, NASDAQ crossing above 20,000. The dollar's been up, so the euro's been going down. We're actually switching to uptrends with the euro, British pound, and Japanese yen. So good time to do some traveling if you want to go to those areas. And this is where we're seeing another disconnect. It's very similar to the NYSE advanced decline line. The S&P's been holding up, and that's the weighted version of the S&P, where the equal weight version is actually showing some weakness. Is this working into some kind of an oversold condition, or is this foretelling some kind of potential weakness that's coming into the market? All right, then looking at the ratio between the two, when this is going up, that means the S&P weighted index is outperforming the equal weight version. And here's another way of measuring this. When this is going down, that means the equal weight version is underperforming the S&P, and that's why we're seeing this really drop. And this is kind of interesting, not setting a new all-time high with the S&P, but we did with the NASDAQ. So as of right now, this is a non-confirmation. And this is kind of a new take on Dow theory that I usually only go over the weekend, but since we set a new high here and we're seeing this discrepancy, I wanted to point this out. But instead of using Dow, the Dow is part of Dow theory, we switch it out for the S&P. Instead of using the transports, we use the NASDAQ because that's more of an indication of what our economy is really like now. It's more realistic. So right now, this is a non-confirmation, and we're not seeing that. When you look at the S&P equal weight, it's going down, and we're not seeing that confirmed by the QQQ equal weight. And you can take that a couple of different ways. This means that the big stocks are really controlling the S&P right now, even though it's not setting a new all-time high. But the fact that the QQQ is doing quite well in and of itself, but it's not just the big stocks that are really controlling things. Yeah, kind of try to figure that one out. The Dow is continuing to drop off here. A week ago Friday, it set an all-time high. It's been drifting lower below this pivot point. We'll see. Is it going to come down to its 50-day moving average? Will that be some kind of a level? We've actually dropped through that before. We'll see if something like that happens again. And the volume's all crazy right now with the data that I have. And we're negative with the Elder's Impulse system for the diamonds, setting an all-time high right at this R2 pivot point with the NASDAQ. That's pretty positive there. Also, at an all-time high with the NASDAQ 100 actually going above this R2 pivot point, which could have been acting as overhead resistance. The Qs are positive when we look at the Elder's Impulse system. Momentum for the NASDAQ 100 is positive. Small caps coming back up right to this pivot point here. They were up a little over 1/3%. So that's encouraging there. But to see these nice little up thrusts and then this trailing off going down, a lot of folks are really anticipating that the small caps are going to do better. And we're not really seeing that all that much yet, other than if we look at growth to value at the small caps, growth is holding up quite well. Here's the Russell 2000 small caps. Turning up, it's still below 50 with the RSI, still above the 50-day moving average, but the momentum as measured by the MACD is still negative. And we're negative with the Elder's Impulse system for the small caps. Mid caps, another area that folks are kind of hoping will do better, have not been able to get back above this pivot point after closing below it on Friday. You know, there was one time not so long ago, look at when we came down to this 200-day moving average and bounced up off of that. Are we going to come down to the 50-day moving average? Are we going to fall all the way to the 200? See, that's why I want to let the market determine what's actually happening instead of just saying, oh, well, this is magically going to happen. And it might play out that way, but we want to wait until we see the evidence of these things happening. And we're negative with the Elder's Impulse system for the mid caps. And holding up okay, but not setting an all-time high with the Wilshire 5000. Also up 0.45% with the total U.S. stock ETF. FANG index, that's where it's at right now. Facebook, Apple, Amazon, Netflix, Google, Nvidia. Setting another new all-time high after setting one on Friday. And we're breaking above the short-term trend line. So we are finally breaking above what could have been this shorter-term resistance. Apple was up 1.17%, all-time high there. Amazon up 2.4%, setting an all-time high. Microsoft was up almost 1%. Google up 3. Is that a 5 or a 6 right there? But setting an all-time high that way. Meta was up 0.71%, but not at an all-time high here. Nvidia was actually down and dropping a little bit below its 50-day moving average. And we're seeing the semiconductors showing some improvement, and I'll go to those charts here in just a moment. And Nvidia's not helping out. Could that even be a positive setup too? Seeing some improvement in the semiconductors, and Nvidia hasn't really even kicked into gear yet. Or is NVIDIA's weakness indicative of seeing more weakness in the semiconductor? See, you can twist it around either way. That's why we want to look at the evidence here. Tesla just screaming to the moon these days, looking really good. And Netflix up 0.25%. This is why the index held up and actually ended up being positive. This is what I'm looking at with the semiconductors. This is the SOX index, and this is where we see a bit of a concern, but it might be improving. We've been below the 50 and 200-day moving averages. Well, we've been bouncing back up, and we're coming back up to the 50-day moving average. But we've just seen a recent death cross here. But if we can get some strength underway and really continue to go up here, that might make this death cross a short-term death cross that could turn back into a golden cross. Let's see how that plays out. And we're also showing an improvement here with the semi to tech ratio, where for the most part of the second half of 2024, the semis have been underperforming. Is that starting to change now? We saw it after Friday, a nice up move with this ratio. We saw it after Monday, but now we need to see this follow through and not just fake us out and then end up not really doing anything. This is more positive. The SMH semiconductor ETF came down. It's been holding above its 200-day moving average, now starting to break above its 50-day moving average. And then here's a rainbow that's plotted on there where we're starting to come out a little bit of the rainbow. If we could continue to go up, of course, that would be even more positive. And we look at a ratio between the semiconductors and the Dow, where we're coming back up. This was a concern. We were coming down with this ratio. Now this ratio is starting to go back up, and that could be more positive. And world stocks versus US stocks, seeing a real drop off here in the short term trend, but the longer term correlation is still strengthening. The dollar's in an uptrend. So, like I said, if you want to do some traveling, you get a pretty favorable exchange rate. And we were down, this shows it being down with the 10-year yield, where again, take your pick there. And we were up just a little bit here based on price, but I have this being down slightly based on price for the 10-year. This is a concern, and I pointed it out over the weekend, and it's still a concern. And over the weekend, I said, are we going to drop to the 250-day moving average? Well, we've actually dropped a little bit below that. This really can be something because we came down to this level in late 2023, hit the 250-day moving average, and boom, we were off to the races after that. Then earlier in 2024, down to the 250-day moving average, boom, we were off to the races. We're coming down. We're actually a little bit below the 250-day moving average. Are we going to keep falling down, or are we going to turn and boom and go back off to the races again here? Just something else to watch. But we're still looking good with our growth to value ratios with the Qs to S&P, discretionary to S&P, large cap growth versus large cap value. This is part of the potential setup that I've been alluding to. And we're looking good with the large caps, mid caps, and small caps. So this could feed into the idea that the smart money is coming in, buying in these areas before we're seeing it actually reflected in the price of the indexes. And then the S&P to utilities ratio improving here as the S&P has been outperforming utilities. And we're going down with this ratio where staples are underperforming the Dow. Staples are more defensive. And in a more positive environment, we want this ratio to go down. All right, well, that's the outlook then for Tuesday. We're still positive coming into that period of more intermediate term positive seasonality, but we still see this weakness that I was going through. We're going to get retail sales. That's a big report. Industrial production and capacity utilization will be coming out, as well as business inventories and the NAHB housing market index. And then all the crazy stuff going on here. We'll see if we have to add the Baltics to the list. And then Wednesday, we're going to get the Fed coming out with their announcement. We're going to get jobs data on Thursday, and we're going to get core PCE on Friday. So it's a pretty busy week here. And here's what it looks like for Tuesday's session. I have it marked off here in the red box. Seasonality, not much to really pick on here. We are coming into the options expiration week where we're up more than down historically. But when we look at going back to 2002, the Dow is neutral to negative, where the S&P and Nasdaq are neutral to positive. And here's where we're at. We now, according to this chart, during an election year, we may get some positive seasonality going into Tuesday, but it doesn't really last all that long. We get one good day and then we have a negative day, and the Fed's going to be coming out, and that's a crazy day in and of itself. It starts to go up with a little bit more enthusiasm here as we work our way through the latter part of December. Tuesday is a coin flip in 2023, and it's the least positive day in 2024. This is part of the positive seasonality according to the Carson chart. And then this is trying to match up what happened from 2016 and then Trump 2.0 and then covering all the elections since 1960, blah, 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 where we've already seen a nice little run up after the election. And then this is how things may play out going forward. Tom Bowley, we're into the positive time now, where we're coming up into the middle of December, where we tend to see positive returns according to his research. And then this is what we call the January effect. Some people might call it the Santa Claus rally. Some people call it hocus pocus. But we're coming up into that time where we are expecting, at least the market is, and historically, this is what's happened, where we see small caps really start to do well up until about March or so. Then the warning signs, we're still a bit concerned about accumulation distribution. It's still below the moving average, but the Chaikin money flow is improving. The Chaikin oscillator ticked up a little bit, but it's still negative. We're seeing weakness in the advanced decline lines, and this should be on the other slide. The 5 and 10-day equity put call ratio is now going back down. And our McClellan oscillators and summation indexes, those are negative and causing some concern. We're seeing weakness in our oscillators. The Copic curve is turning over negative. The bullish percent indexes for the S&P and NYSE are declining. We still have this non-confirmed Hindenburg-Omen. Parabolic SAR is negative. The Swenlin trading oscillator and the 20 and 50-day moving average studies for the S&P are negative. And the ultimate oscillator, I finally switched that over here. That is negative. The positive signs are the vortex, but we're not really seeing any great strength there. Where we're seeing some nice things is the growth to value and discretionary to staples ratios. And we're still negative, or I shouldn't say that. We're weakening, but we're still positive with the 100 and 200 period moving average studies. The bullish percent index, it was flat for the NASDAQ 100, but it's still giving us a high reading. The ease of movement is still positive, the money flow is positive, and the momentum for the NASDAQ 100 is positive. Financial sector didn't show that chart, but it's continuing to show a little bit of weakness these days. And then the Hindenburg Omen. And we'll just have to see. We've got until the 19th to see another spike up here, and we haven't seen one at least yet. All right, our conclusion. We are positive, though, and we're coming into this time of positive seasonality, but there's still this weakness that's developing as the large caps and growth are really holding the market up right now. And in the short term, we had been pulling back. We're just kind of chopping along sideways. We're not really showing any conviction right now. And we're potentially out of that period of weak seasonality. And we're also just kind of chopping along sideways in the intermediate term, but this is where our indicators are showing some weakness. We're still positive in the long term, even though our longer term moving averages have been declining. Thank you. I really hope you found this helpful, and I hope that you have a great day, and I will talk to you in the next video.